So the market's at the halfway point, and wanted to bring this up because I think it's always good to take stock out of, what we're seeing, what's going on with the markets at the halfway point, and we're almost there, right? We're in the last week of June. Halfway point for will be this Friday, and so where do the markets sit? And I took some notes here where the individual indices, the largest indices in North America sit. So at the top of the list, and I've mentioned it earlier in the show, is the NASDAQ, right? Up 27.5%. NASDAQ made up of, well, what do you know? What do you guess? Tech stocks, right? A lot of the big tech names are part of the NASDAQ, helping drive that indice a lot higher. Just comparing it to last year, the NASDAQ actually had about a negative 30% return last year. And just at the 6-month mark, they've already made back most of those losses. S&P 500, largest index in the United States, made up of 500 companies. That's up 14%. I mentioned that. And again, the S&P 500, the tech stocks make up the largest component of those 500 companies, or well over 30% now, depending on if you're counting information technology as tech or not, but definitely the largest component or sector of that indice. And that is helping, or index, and that is helping that index move significantly higher. The Dow Jones, as we know, Dow Jones Industrial Average is what we see a lot in the news, and that is really 30 stocks, only 30 stocks, and really to our portfolios doesn't matter an awful lot, but that index is up about 2.5% year to date. There's more of a balance in the Dow Jones. You have some bank stocks, you do have some tech, but you have other names, industrials, etc. And some of the other areas, as we saw earlier in the show, not faring as well. And last but not least, Toronto Stock Exchange, TSX. How is the TSX faring? Well, it is the worst performing index out of all the indices right now. If you look at them, and here you have a chart of the TSX, less than 2% growth so far year to date. And I think if we, pull up, you can see, I think we have a chart of the S&P. You can visually see how well the S&P has done. There it is there. And take a look at the NASDAQ. I think we have a chart of the NASDAQ. Again, we've seen this chart before. You can see how well it's done. But going back to the TSX chart, you can see that you really haven't seen much in the way of gains. And this kind of brings up, a point that I wanted to make when I speak about the indices at the halfway mark is a lot of individual investors like to compare their investment advisors' returns that they help them get with their portfolios, or just their portfolios returns in general, to an index, right? You often hear, okay, well, you got to be able to beat the TSX or do better than the S&P 500 or the Dow or whatever index you're comparing the returns to, because most people say, well, if you can't beat the index, I can go out and buy, just an ETF that just follows the index, and I don't need an investment advisor to do that. So hopefully an investment advisor or a mutual fund manager or a hedge fund manager will beat the index. And I have a bit of a problem with that, because once upon a time when the indices were very balanced. So yeah, the NASDAQ pretty much, at least since I can remember, always favored tech stocks, but the S&P 500 was more balanced. Banking, or the bank sector, made up a larger piece of the S&P. The oil sector made up a larger piece. Retail sector, pharma, they made up larger pieces of the S&P 500. The S&P 500 wasn't dominated as much by technology as it is today. So you could say, okay, well, can my portfolio beat a balanced index? And the TSX, primarily was always favoring, financials or banks, materials such as gold and oil or energy. Those are the three sectors, or the main sectors, that TSX always seemed to favor. And those three sectors always seem to make up about 70 to 80% of the index. So it was always hard to compare against the TSX. But overall, the S&P 500, the S&P 500 to me has become an index that is heavily skewed towards technology. And to me, it's hard to say, can you beat the S&P 500? Well, the S&P 500 is technology for the most part. And so unless you have a lot of tech names in your portfolio, it's going to be hard to beat the S&P 500 or the NASDAQ this year. So comparing portfolio performance to the S&P, to the TSX, which is only skewed to three sectors, to the NASDAQ, is very difficult. Do you want to compare it to the Dow? Well, that's only 30 stocks. So when someone says, well, you need to beat the index, or, you're just, not worth investing with an investment advisor, a hedge fund manager, or a mutual fund manager, I take issue with that, because I think more and more it becomes difficult to beat the index. And some years it's actually very easy to beat the index, like last year, if you were comparing to the NASDAQ, which was down 30%, or the S&P 500, it was easy to beat because that was down 22%. And most individual investors didn't do as poorly as that. So comparing your performance to an index has become more difficult. I personally would say, has your portfolio meet your expectations? Has it basically met all the expectations that you set for it? Is it on track to reach your goals? And if the portfolio is on track to meet your goals, that to me is a lot more important than whether it beats an index that is heavily skewed in one direction or not. So keep in mind, these indices are no longer the way they used to be. And if you're looking for performance and what to, I guess, to measure performance on, measure it based on, is it meeting the criteria that you've set out when you first started? Are we on track to meet your investment goals? And if you are, I think your hedge fund, your mutual fund, your investment advisor is doing a great job.